Welcome to the deep dive. We've got some material here on the ForeAccumulation II fixed index annuity from Forethought Life Insurance Company, described by Diversified Insurance Brokers.
That's right.
And, you're looking to get a handle on this quickly for retirement planning. So our mission today, unpack the key features, the potential upsides. Let's just dive in.
Okay, yeah. Let's figure out if this could be a good piece of the puzzle for you. So looking at the materials, the main idea seems to be growing retirement money, but also protecting it.
Protecting it how?
Well, it uses these strategies linked to market indexes, but critically, it aims to shield your principal from losses if the market goes down.
Okay. So trying to get some market upside without the full downside risk. The info mentions different ways interest gets credited, fixed rates, S&P 500 links, other indexes too. How does someone choose?
Yeah, that's where the personalization comes in. You can sort of lean towards more growth potential or more stability depending on your comfort level with risk. These index-linked strategies, they let you potentially benefit if the market does well.
Potentially.
Well, yeah. How those gains are calculated can differ. Sometimes there are caps, limits on the upside, or participation rates, which dictate how much of the index gain you actually get credited. But the big selling point is that downside protection.
Right, you mentioned that. The idea that your contract value won't drop just because the market had a bad year.
Exactly. And any gains you do get from your chosen strategy, they're locked in each year.
Locked in. So they become part of your protected value.
Precisely. If the index strategy works out 1 year, that gain is added, and then it's safe from future market drops. It sort of builds a new floor.
Okay. Now, I saw something about a bailout provision. Sounds like an escape hatch.
Kind of, yeah. It gives you flexibility. If Forethought, down the line, lowers certain renewal rates, like the cap or participation rate on an index strategy below a specified point, this provision lets you pull your money out.
Without the usual surrender penalties.
Correct. It's protection against future changes that might make the annuity less attractive than when you bought it. Got it. That makes sense. What about legacy? There's this enhanced death benefit, the EDB.
Right, the EDB. Now, this is an optional rider, so it costs extra. But what it does is guarantee that the death benefit will grow by a simple 7% each year on your initial premium for up to 15 years.
Okay, so even if the contract value itself doesn't grow much, there's this separate calculation ensuring a minimum payout for beneficiaries.
Exactly. Your heirs get the greater of that enhanced death benefit value or the actual contract value when you pass away. It's for people really focused on leaving a predictable amount. But again, you have to weigh that extra cost.
Sure, cost is always a factor. And what if you need the money while you're still alive? Liquidity.
Yeah, there's some access. Typically, after the first year, you can withdraw up to 10% of your contract value annually, penalty-free.
Okay.
Plus, there are often options to turn it into guaranteed income for life, like an annuitization payout. And of course, you can always access the surrender value, but
there might be surrender charges, especially early on.
Right, those usually decline over a set number of years.
And who puts money into this? Is there a minimum?
The material mentions a minimum premium, usually around $25,000, and it's suitable for different types of funds, qualified money like from an IRA or 401k, or non-qualified money, just regular savings.
So, summing it up, who's the ideal person for this ForeAccumulation II, based on this info?
Well, it seems geared towards folks who are really prioritizing long-term accumulation, yes, but maybe even more so, that protection from market downturns. People may be a bit wary of stock market volatility.
And that EDB feature adds a strong legacy planning angle, too.
Definitely. If leaving a specific growing amount is a high priority, that optional rider is a key feature to consider.
Okay. So key takeaways seem to be market-linked growth potential, but with a safety net underneath, plus options for locking in gains and planning for beneficiaries.
Yeah, that covers the core benefits described. The real question for anyone listening is, how do those features stack up against your personal retirement goals, your timeline, your comfort with risk?
Right. You'd want to maybe compare this against other retirement vehicles or dig deeper into exactly how those index strategies calculate returns. Understand the caps and rates.
Absolutely. It's all about finding that right balance, isn't it? That balance between wanting your money to grow and needing to feel secure that it won't disappear in a market crash. Something to definitely think about.
A great point to end on. Thanks for walking through this.